Managing risk is probably the most difficult thing to master when just starting out. I got 3 tips that are going to help you avoid the most common mistakes that new traders make when managing risk. Let's hit it! What's going on, guys? Welcome to Own the Chaos. My name is Brad Smith and I'm your host here, and I trade over-the-counter stocks, hence the play on words Own the Chaos, because it's so volatile and it can be so overwhelming and so scary. But what I try to do is to help beginning traders figure all this out and own the chaos. And so what I've decided to do today is just kind of go over how to manage that risk. Risk management, as I said before, is one of the toughest things to do when trading over-the-counter stocks and just trading in general. And so I feel like it's so much easier to throw risk out the window because of the potential that you can see down here. So many people want to just hold on these stocks that they've bought so low that they want to really see that big home run, right? But when just starting out, you want to focus on getting those little bunts and base hits because they still end up getting you all the way back to home base, right? So I want you to focus on that if you're just starting out. And the first way to do that is to keep your profits close and your losses close. What I mean by that is don't hold on if you're green, okay? If you're profiting off of a stock, don't hold on to it forever. And the most important thing to do is, at the very least, protect that initial investment. What I always try to tell people to do is, look for whatever potential you have, set that plan, and then protect that initial investment. That way, whatever is left over, say if you want to hold, if you see long-term potential and you want to hold on to that, at least protect that initial investment so that you can use that to buy something else. And then you can leave your profit sitting in there if you want to maintain or sustain some sort of long-term hold on that. That way, whatever you sell on that, even if it's something small, it's still profit. Okay? And then that way, if you're afraid you're going to miss out on some big major run later on, if there's a catalyst that's going to be expected, you can still hold on to it and still experience, whatever major run you might be hoping that's coming out based off of your due diligence. And then you can use that initial investment that you protected to go out and buy something else in the meantime and still make money. Okay? On the flip side of that, protect your initial investment by cutting losses short. Okay? The OTC is a very volatile market. It's not unimaginable to watch something drop 50% and then all of a sudden your investment has been cut in half. But there's always that fluctuation. So, you may be stuck in there a little bit or whatever, but you have to manage your risk. If you set a plan and don't set stop losses. Whatever you do, stop losses will always get tripped by market makers and you always lose out on stop losses. So don't do that. Set a mental stop loss is what I always tell people. Set that mental stop loss and make a plan and say, you know what, I'm not going to allow myself to take any losses that are below, let's say 10% or 15%. And then get out of that and stick to that plan. The hardest thing about that is making sure you stay disciplined and cutting those losses short. Don't hang on to something forever just because you think it might come back, because then you will just hold on to that bag forever. Cut those losses short so that you can make them back quickly and then just move on. Okay? So, making sure that you take profits early and making sure you cut losses early is the key. That is key number 1. Key number 2, when managing risk, when just starting out, is making sure you're taking small positions. Don't bite off more than you can chew. I always like to recommend not taking a position that takes up more than 20% of your entire portfolio. That way you can use other money to buy other things. And the thing is too, is that like, even if you do all the due diligence you want to do and you feel like you've got this thing dead to rights and you want to put all of your money into that particular stock, that is the wrong thing to do. There's always that saying, right? Don't put all your eggs in one basket, and it's the same thing here. Don't use all of your money to buy into one particular stock. Diversify your account. I usually have anywhere from 8 to 10 positions at any given time. And that's what you should try to work towards. Now I understand, like a lot of you, I always try to suggest starting off between $1,000 and $3,000 just when you're first starting out. When you start putting your skin in the game there, $1,000 to $3,000 is a pretty standard amount to start off with when you're just starting trading. And make sure you're splitting that $1,000 to $3,000 up. Even if it's in only $200 increments, at least it gives you some sort of baseline to say, okay, this is what my risk tolerance is going to be. Because if you experience that 50% loss, because that does happen, at least you only lost $100 out of it, right? So $100 is much easier to swallow than if you're going to throw all $3,000 into something, you lose 50%, and then you lost $1,500. Okay, so that is another thing. Smaller positions until you start gaining a much stronger risk tolerance, because you've gained more confidence and that you know what you're doing. So smaller position sizes will help you minimize risk, especially when trading in this very volatile market. So the third tip is kind of goes into what I was talking about in the second one, is diversity. Making sure you diversify your portfolio. Look, there's plenty of times where you think that you got a stock that's dead to rights and you figured it all out, but somehow, some way, it doesn't go the way that you wanted it to. You're going to have a much easier time dealing with that particular stock if you've got other ones that you've done all the proper steps as far as your due diligence goes and they're working out for you, than that one that didn't. So if you have your account all spread out and you have multiple plays going on, you're not going to be as upset taking a loss on one of those, because maybe all of your other 4 or 5 or 6 positions are doing much better than that one or maybe 2 that you're going to have to end up taking a loss on. All right, so making sure that you take profits early and keep your losses tight, then taking smaller positions, and finally diversifying your account. It's real short, it's real simple, it's real sweet. It's really not that hard to comprehend. The toughest part for you is going to be developing that discipline. The discipline is the toughest part to do, and it's nothing that I can teach you. Nobody can teach you discipline. You're gonna have to figure that out by yourself, because it's so hard. That's something that's just not teachable. It's not coachable. It just takes repetition and basically beating it into your own head that, you know what, I am not going to deviate from this plan. Stick to that plan, and I promise you, you will come out a better trader. So again, these are 3 tips that I can give you to try to avoid those most common mistakes that beginning traders make, and I hope that helps you. If it did, please like and subscribe to this channel. I come up with videos 5 to 6 times a week. If you learned something out of this, if you got something, I'd appreciate the like. Just smashing that like button. It gives me the support that I need to keep this channel going. And finally, if you are looking to step up your game a little bit, if you're looking to, I don't know, gain an edge and learn from maybe some of the mistakes that I made when I was a trader, check out WeTradeHQ.com. It's a community that I've helped create that we have combined all kinds of traders, whether you're trading over-the-counter stocks like you are, like I am within my channel, or if you're trading bigger board stocks, futures, forex, cryptocurrency, it doesn't matter. We have built a community, a social community where people can connect and talk about whatever it is that they're trading. And then I also have a comprehensive course there on WeTradeHQ as well. I encourage you to check that out. There's a lot of free stuff that you get when you go and purchase my course. You get 90 days free, and you can link up with me and other folks that are in that mentorship class, and it's 90 days free. You get to join us in the most volatile time of the market and see what we're seeing and try to find value in stocks the way that we do it. And it basically just gives you that extra edge that you need when first starting out. I think it's a great program that we have going on. Lots of good reviews that people have come back and given us great feedback on. And I just think it's something really special that we've got going on, and I really think it's going to take off here soon. So check it out. And also, if you buy a course as well, you get a free t-shirt. You get a free WeTradeHQ t-shirt. And so yeah. So anyway, check out WeTradeHQ.com. Like and subscribe to this channel to get more awesome content like this. And as always, guys, I will see you all before the bell, and B Smith is out. My name's Jason Bond, and I've been killing it in the stock market. Been killing it. Come buy my $10,000 course, and I'll help you make 5. All right. Okay.